Hello and welcome to this session in which we will discuss when would the auditor issue a qualified or a disclaimer of an opinion. Now, when an auditor audit a financial statement, the whole purpose is to issue an opinion. That's why we audit the financial statement. The end product is an opinion. To get to the end product for the financial statements, you need to prepare and collect and evaluate what we call evidence, record, to support your opinion. The question becomes, what happens if you cannot, for one reason or another, you cannot collect the evidence? What do we call this? We call this in accounting a scope limitation. When there's a material scope limitation means you have difficulty collecting evidence. We are not discussing here any accounting issues, financial issues, GAAP, generally accepted accounting principle. Here we are discussing actually GAS, generally accepted auditing standards. When I discussed the GAAP issues, I told you they're not GAS. Here we're not discussing GAAP, we're discussing GAS, audit, scope limitation. Auditor, under those circumstances, when they cannot collect evidence, they have to decide whether to issue a qualified opinion, and also qualified opinion could be issued for GAAP purposes, and we saw that in the other recording, or we'd have to issue a disclaimer. When do we issue a qualified opinion? When do we issue a disclaimer? The auditor will use their professional judgment. What could influence their professional judgment? All depends on the importance of the evidence emitted, on the procedure, because you need the evidence. You need to perform a procedure. For example, if you have inventory, you have to count the inventory. You have to physically count the inventory. If that procedure is omitted, how important, how severe that is, or if you cannot confirm account receivable. So the auditor must evaluate how crucial the omitted audit procedure, simply put, you cannot perform a step in collecting evidence, informing this opinion. How severe is that? So when you assess this, you would assess the nature, the magnitude of the potential effect, the significance of this omitted procedures to the whole financial statement, and the number of financial statement impacted. Is this issue only impacting one area and that area is not large and the problem is contained? Or if I omit this procedure, if I omit inventory, I'm gonna misstate my cost of goods sold, my gross profit, my net income, other accounts. Is it widespread or is it limited? This is what we will discuss in this session. When do we issue a qualified? When do we issue a disclaimer of opinion? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here. For qualified opinion, an auditor issue a qualified opinion when they are unable to obtain sufficient appropriate audit evidence on which to base the opinion, and they conclude that the possible effect of any undetected misstatement could be material, yes, but not pervasive. So simply put, yes, we cannot collect the evidence, and that issue is material. We have a scope, but it's not pervasive. The scope of the limitation is not pervasive to the whole financial statement. In other words, it's limited to one area. The auditor can still form an opinion, comfortable with issuing an opinion on the whole financial statement, despite not able to count the inventory or perform an audit procedures. In this case, the auditor's report will state that the financial statement give a true and fair view except for the effect of the matter to which the qualification relates. Therefore, you just say, except for this, and we would look an opinion. Everything else we were able to complete. Disclaimer of an opinion. When do we issue this? You guessed it. The scope is both material and pervasive. Qualified, it was only material but not pervasive. Pervasive means widespread, all over the financial statements. It's affecting other issues. The auditor here is unable to obtain sufficient appropriate evidence, period. And if you can't do that, you cannot issue an opinion. The potential effect could be so significant that the auditor cannot form an opinion on the financial statement. Here we have a serious issue. In this situation, the auditor explicitly states that we do not express an opinion on the financial statement. They're not giving an adverse opinion. They're not giving a bad opinion. They're just saying we cannot because there's a scope limitation. And the scope limitation is material and pervasive to a point where we cannot issue even a qualified. Therefore, we disclaim. That's it. Now, is there another case where we disclaim? Yes, we'll talk about it at the end. So to summarize, and I hope this picture starts to make sense, when to issue a qualified, when to issue a disclaimer. A qualified is when the issue is significant, is material, but not widespread. Something like this. You're looking at this picture. You can see stuff. It's colorful. You can see clearly. So a specific issue exists, but sufficient appropriate evidence support the remainder of the financial statement. So I'm okay with this. A disclaimer is issued when you don't see clearly, when the auditor cannot see clearly, and as a result, there's a significant material misstatement and it's widespread. The whole picture is messed up, not only one part of it. So a substantial limitation in scope prevent the auditor from forming an opinion on the financial statement as a whole. So it's more serious, but we don't give an adverse. We just said, we cannot collect evidence, therefore we cannot issue an opinion. Well, you draw your own conclusion. Let's take a look at a qualified opinion due to scope limitation. Okay, this is a qualified opinion report, independent registered public accounting firm to the shareholders of Farhat Company. Here's the opinion. It should be modified to include the appropriate qualifying language, such as except for the effect of the adjustment, if any, as might have been determined to be necessary, we have been able to examine evidence of foreign affiliate investments and earning as described below. It looks here there is an adjustment they could not collect enough evidence for. In the absence of that, we are in good shape. So they told you what the issue is. So an additional paragraph with no heading should be added immediately after the opinion, explaining we were unable to obtain the audited financial statement supporting the company investment in a foreign affiliate stated blah blah blah. You'll have to explain this, and you'd say, look at this note. Basis of the opinion should be modified to include a reference to the additional paragraph, except as above. So the basis of opinion point to that. They'll talk about how did you conduct the audit, critical audit matter, no change, and signature. Scope is different. Here we're looking at the scope again, independent auditor to the shareholder. Here we are, disclaimer of opinion. We were engaged to audit, right? The word should disclaimer in the title, just you have to make it clear. The words were we were engaged to audit the financial statement instead of we have audited. We were engaged. A reference in the paragraph should disclose all the substantive reasons for the disclaimer as described in the following paragraph. Because of the company did not take physical inventory and we are not being able to apply other auditing procedure to satisfy ourselves as to the inventory quantities and the cost of property, plant and equipment, we were not able to obtain sufficient appropriate evidence to provide basis for the audit opinion. That's it. We do not express an opinion. That's our opinion. Our opinion is we don't express an opinion. That's it. We disclaim. Then we have an additional paragraph with no heading immediately after that, explaining specifically. Then basis for, you mentioned the word disclaimer of opinion, disclaim. The sentence reads, our responsibility is to express an opinion. The second paragraph is we conducted our audit in accordance with the PCAOB. Then critical audit matters should be omitted because we're not going to give anything. We're not going to say anything because we might mislead. It should be omitted because the inclusion might imply that the auditor has conducted sufficient audit work to evaluate challenging areas. We did not. That's it. Which in essence, it contradict the essence of disclaimer if you are discussing critical audit matters. If you know what critical audit matters, you need to be familiar with them. Critical audit matters means issues you faced and you dealt with. Well, the problem here is you could not deal with what you needed to deal with. Then you have the signature. Now, as I mentioned, you could have also a disclaimer if the auditor lacks independence. So a disclaimer of opinion should be issued when the accountant is associated with the financial statements but lacks independence. The reason is any procedures the auditor had performed should not be described. If you lack independence, that's it. You don't say anything. I just lack independence. Including such matters might confuse the reader concerning the importance of the impairments of the independence. So simply put, once you know, I don't think I can keep going. We're not independent. We just say we are not independent with respect to Farhat Company and the accompanying balance sheet and the related statement of income, retained earnings, and cash flows. We're not audited by us, and accordingly, we do not express an opinion. That's it. We are not independent because therefore we cannot issue an opinion. So what is associated with the financial statement? Well, when the accountant have consented to the use of their name in a report, document, or written communication containing the statement, or they submit to their client or others financial statement that they have prepared or assisted in preparing, then they are no longer independent. Now, when an accountant is associated with the financial statement of a public entity, but they did not audited or reviewed, what's the importance of auditing or reviewing? You give some sort of an assurance. The form of the report to be issued would be something like this. You cannot, if you did not audit or reviews, no assurance. You have to explicitly state so you don't mislead, because now you're associated with a publicly traded company. The accompanying balance sheet of Farhat and the related income, retained earning, and cash flow were not audited by us, and accordingly, we do not express an opinion. So you have to be very careful in explicitly saying, I do not express an opinion on the financial statement. That's it. Not they are unqualified, qualified. I cannot express an opinion, period. Why? I lack independence. I am associated with the financial statement. I should not be issuing an opinion. What should you do now? You're going to go to Farhat Lectures, look at additional lectures, MCQs, resources that's going to help you do what? Prepare for the CPA exam. Invest in yourself. Good luck. And of course, stay safe.